Okay. There are no stamp duty concessions for property investors. I get asked that quite a bit. And as soon as you come to the party to buy a property as an investor, at the moment there is no concessions there whatsoever. Okay. Now, ongoing tax deductions for properties. This is a really big topic for us in our business, Joe. A lot of our clients, they come to us, they're obviously looking to buy investment properties. They're looking to buy for wealth creation for themselves, but also to help looking at tax minimization. Can you talk to us a little bit about the ongoing tax deductions that are available for property investors?
Sure. So essentially, any cost of running and owning the property ongoing is going to be deductible. So that's interest on the loans, running costs, council rates, water rates, management fees, all those kind of things. And depreciation, which is a big one, which we'll talk about a lot today, which is essentially a write-off of part of the value of the property, the cost of the purchase.
Yeah.
You can get a tax deduction for that if you meet certain requirements.
Okay.
We'll touch on the details, but essentially that's where you can get the best benefit from this if it's negatively geared, which again we'll go into more detail on.
Yeah. Okay.
I might touch on, I know is it the next slide, what you can't claim while I'm talking about what you can claim.
Yeah. So I'll bring up the next slide as well, because I think it's important as well for people to understand what is not tax deductible when you own an investment property. The last thing we ever want is any of our customers getting into trouble with the ATO. So do you want to give us a little bit of an overview as to what is not tax deductible when you have an investment property?
Yeah, so essentially, like when you purchase the property originally, a lot of the buying costs, for example, the stamp duty, lender's mortgage insurance, if you have that, if you're under over 80% LBR, and the costs of legal fees and the like of buying the property, they're not deductible. They're going to add to your cost base.
Okay.
Which we'll talk about when we talk about the capital gain on sale.
Yeah.
But essentially, after that, the running costs are going to be deductible. Other than things like travel to and from the property, that used to be deductible.
Yeah.
That got eliminated a long time ago because people would want to go buy the place on the Gold Coast,
get a trip to
have a family holiday, and claim deductions for travel.
Yeah.
And that got stamped out pretty quickly.
Oh, okay.
So travel and anything like that is not deductible.
Not deductible. Okay, cool. One of the other questions I get a lot in our business is around when is the property, or when is the interest accrued on a property allowed to be started to be tax deductible. So when does that happen? Is it when the property is tenanted, or when it goes to market, or when exactly am I now at a point in time able to start claiming the interest on that loan?
It's a good question. It's essentially when it's available for rent.
Okay.
And when it's available means like you've listed it for, to get a tenant in, advertising.
Yeah.
And they could move in at that point. That's going to be deductible. For example, if you build a house and you have costs incurred in that, in interest and the like, that would be added to the cost base until it's completed and available for rent. From that point on, it's deductible against your taxable income.
Okay. So once we go live on realestate.com or domain.com, that's our point in time when we stamp it at that stage and say we've now got an interest bearing loan against this property, and when we do our tax return, that's when you are going to be looking at, okay, now we can start to claim the interest charges against this loan.
That's right.
Okay, awesome. All right, good to know. All right. Land tax, another beautiful tax that gets passed on to our property investors. How does it calculate? How does that work?
Yeah, so essentially every state has a threshold for land tax. So you need to be very specific on where you're looking. Like you need to know those land tax rules, and we can run through each individual person when they're buying. Essentially, New South Wales 1.2 million. With your primary place of residence, that's exempt. So you own the $10 million place in the eastern suburbs, you're not paying any land tax if you're living there.
Yeah.
But then if you buy an investment property after that, then you'd be paying land tax if it's over the 1.2.
1.2. Okay.
Yeah.
Okay. One of the important things I think to touch on here is the difference between the value of the property and the value of the land.
Yes.
Because there's ultimately, when your evaluation on a property has two components, essentially it has the land value and it has the actual dwelling, the actual
Correct. Yeah,
property
the house,
itself,
yeah.
the house itself. So it's important to understand that the if you have the most beautiful home that has cost you an absolute arm and a leg with all your fixtures and fittings as an investment on it, but the actual land is a really, really small block of land that doesn't really hold much value, then essentially we're looking at that value of that land rather than the dwelling itself. Is that fair to
Correct.
say?
And you can actually look up what the value is of each lot of land.
Yeah.
Especially in New South Wales, like every state's the same. We work mainly in New South Wales, but you can essentially like find the property on New South Wales Revenue, New South Wales, and then find the code, and then it'll show you that. Like you can look up the value of the property, the land value of the property.
Okay, so that's like a folio ID, is it?
Yeah.
Or so you've got a folio ID. So anyone who's got a contract of sale for their house, if you look up the folio ID, it's on the front page of that contract. You put it into that website, it'll take you there. Now, most of the time you get a letter notice when people are getting the rates are increasing and things like that. That's when you get a notice that says, hey, this is what your land value is increased generally by. So that's the things customers need to look out for when you're looking at valuations on land and things like that. Is that
Yeah, yeah. The other thing to remember is like, even though you don't think you have any land when you own an apartment, there is land. They do look at land.
Yeah.
Land tax for apartments.
Yeah.
So, I've got one that I live on level 11, and the value is 350,000 land.
Right. Okay.
Up
in the sky.
Up in the sky. Yeah.
So
they'll look at the whole area of the complex
and
what's the land value divided off.
Yeah, based on square meterage size of the apartment. So understood. Okay, cool. All right, so let's talk about the cutoff days. When is that payable? And let's touch on that first. I do have another question for you around other states, and particularly a lot of our customers at the moment are investing in Victoria. Not sure, but Victoria, no threshold there, so straight up, like the government there has changed. They have changed the rules, so there's no threshold at all there. Essentially, it's from $0 of the land. They
I think it's like 300 and something thousand.
300. Yeah.
I need to check the exact amount, but it's in the 300,000. Yeah.
So it's about I think it's about $1,000 in and around that sort of price point, $975 from my calculations at that level. But anyway, as I said, that's a state by state base. Okay, so it's just important that when customers, I think, are building a property portfolio and they're looking at a number of properties in the one state, often when we talk about strategic advice around that, we can take that into consideration and looking at, well, maybe you may breach that land tax threshold, so let's consider that in the overall strategy where you might go one in Victoria, one in Queensland, one in New South Wales to keep that land tax component sort of in check. So it's always a good one to keep front of mind, because a lot of people do tend to forget about it.
100%. It's very important.
Yeah.
And also, like, the values of land is going to increase in other areas significantly more than in some. So if that's, you got to take that into account with your maths.
Yeah, absolutely. When's it payable?
March.
Okay.
They will send you a notice. It's the date 31 December.
Yep.
Whoever owns the property at that point is essentially liable.
When it gets okay.
And you'll get a notice in the mail. If you own we'll come to trust and stuff later on, but essentially sometimes you might be eligible for lower amounts.
Yeah.
And you might have to prove that case.
Yeah.
So you've got a few months to do that.
Yeah. Okay. I had an interesting case myself where I held the property over the 31st of December, and I got a land tax bill on that one. But one of the exemptions that you have, when I spoke to the state revenue on it, was that you do have a period of time of moving from the property into the your new principal place of residence. So if you do get a land tax bill, what should somebody do?
Yeah, I mean, I'd speak to your accountant, but I'd also speak to, if you own it all in New South Wales, I'd speak to Revenue New South Wales. They're actually pretty good on this stuff.
Yeah.
And say, this is my situation, here's the properties I own, this is what's going on.
Yep.
For example, if you own in a trust, you need to prove that the trust is a resident trust. So you can't distribute to non-resident beneficiaries. Otherwise, you get hit with the additional tax.
Yeah.
Which can be even for a $350,000 land value, it's over $20,000 a year.
Yeah. Wow.
Right. So if you just get hit with that notice, ask the question.
Yeah.
At the time.
Okay.
Before you pay it.
Good to know. Good to know. Okay. All right. Moving on. Purchasing property in a trust. Is this a good idea? I would hands down say that this is probably one of the most frequent question that I get asked when I'm working with our investor clients. Do you want to talk maybe a bit about the different types of structures in terms of trusts that are available to customers when they're looking at buying investments?
I'll tell you the answer to that for the first one. Is it a good idea? It depends.
It depends.
Sometimes,
the grey area,
sometimes
Joe.
not.
I love it.
Essentially, there are more types of trust, but I'll touch on the main ones, and that's a discretionary trust and a unit trust.
Yep.
The difference is a discretionary trust, the trustee has the choice every year on how to distribute the profit to beneficiaries. And because of that, there's no fixed entitlement of anyone to own the property, essentially. The trust owns it, but there's no individual person that has a fixed entitlement to it.
Okay. Yeah.
Because I could, if we were in a trust together, I could distribute 1 year to you and 1 year to me.
Yeah. It's
So from a land tax point of view, their view is no one in particular, they can't assign that threshold to anyone in particular.
Okay. So in essence, owning a property in a discretionary trust can exasperate or basically take away a threshold of
in New South Wales, for
in New South
example,
Wales.
you're not going to get a land tax exemption at all. You're going to pay it on every dollar.
Yeah.
However, in Victoria, there is a threshold.
Yeah.
For a few $100,000 per entity, even if it's a discretionary trust.
Yeah.
So, you need to be specific as to which state you're buying in and to which structure as well.
Yeah.
Now, unit trust is the other option. There's unit holdings which have a set amount of units, so they can align that ownership to an individual if it's individual unit holders.
Yeah.
Again, if you had a discretionary trust that owns the units in the unit trust, again, you're going to have the same issue as before.
Yeah.
Because you can't align it to anyone in particular. So it can be beneficial where, for example, you're already over the land tax threshold individually, and you want to be able to just continue the ownership on long term to family members down the track, and it just builds up wealth, and it's positively geared. Okay. So if you're making a profit on the income, you can then choose to distribute it to ways that aren't yourself, and that might minimize your group's tax.
Yeah. Yeah.
But for negative gearing, if you just held a property that was making a loss from a tax perspective,
There's no
that's going to get stuck. That loss is going to get stuck in that trust.
Yeah.
And there's really no tax benefit other than if you then sold the property at a future point.
Yeah.
That would offset the capital gain.
Yeah.
But it's not a tax strategy to have big losses if you don't have any income
coming into to offset or to essentially offset that.
But one example is if you're self-employed, you have a trading entity, you make big money and you pay a dividend to a trust.
Yeah.
If that trust owns a property and made a loss, then that would offset against the dividend income. Then you get the franking credits out, tax credits out. Yeah. So it can be beneficial.
Yeah.
But especially if you already own enough property outside of it.
Yeah.
That you're over the land tax threshold.
Yeah. Okay. Yeah. Okay. So what I'm really hearing there is that it can be beneficial. It just really does come down to your personal circumstances.
Correct.
There simply on the back of the unit trust distributions and land tax.
I mean, the first question I asked someone who asked me this question, because we get it all the time as well, is it going to be positively geared or negatively geared?
Yeah.
And invariably they say it's going to be negatively geared. We're going to have a big amount of debt and our aim is for a capital growth.
Yeah.
And we want to offset our income.
Yeah.
So essentially, it doesn't help to do that in a trust, and you're going to be paying land tax. So in that situation, it's probably going to be individually owned, and it's going to be individually owned by the person in the highest tax bracket.
Yeah.
If you had two spouses that were buying it.
Yeah.
Or if someone's at a higher risk profile, then we look at that as well as to whether,
asset protection.
from an asset protection point of view, do we want to have an individual investment asset in a business owner who's at a higher risk of being sued, for example?
Yeah.
So you got to mix all those things together to say what entity and who and
is going
to own it.
No, understood. What I've done is we worked on a little bit of a cash flow analysis on terms of an investment property, which I'm going to just share now. And I think it's important to show, like we touched on the tax aspect of if the property is negatively geared, what that impact is in terms of that tax minimization structure. And we've done it just based on somebody who is on, let's say, that higher taxable income at that 250. I'm just going to check. George, can everybody see that on our screen? Okay, so the answer to that is no. So let me see if I can get that working for us. I'm just going to stop sharing for a moment and I'll do it again. See if I can work there. Okay.
Yeah.
All right. I think everybody can see that okay now, hopefully. So so essentially on this one here, we are looking at a price point of $650,000. Now, in our workings here, we've got all our cost acquisitions for the investment property here, and down here further, we've got all our expenses associated with the purchase, which is interest, council rates, any land tax, property management fees and insurance costs. And over on the right hand side, we have our rental income from the property. Now, this is the important part, which we spoke about, which is that negative gearing component, because we have a expense of $46,000 for the outgoings, and we've got income of $28,000. So the property essentially is negatively geared by $18,000 or $18,714 from a cash perspective. From a cash perspective,
Yeah.
Okay. So what we're saying is that if you have a trust owning the entity, that $18,000 is essentially absorbed in there, and
it just sits as it gets carried forward if you don't have other income that you're offsetting it against.
Okay.
From, say, business or other investments.
Yeah.
Yeah, that would essentially stay there, plus the depreciation if you wanted to claim it, but
yeah,
we can touch on that whether you would or not.
Yeah, sure. So this is the shortfall. These are your tax deductions essentially, which would be typically your negatively geared component, your depreciation, and any other associated costs with running the property there.
I might just touch on the depreciation before we get to
sure.
Yeah. So it's really important that this is why like buying the right property is so important, and you can touch on I guess what buyers agents would do as well.
Yeah.
But if you buy a really old property that's never been renovated, and you're not going to renovate it, and you're just losing $18,000, and it's more than 40 years old,
yeah,
you're essentially not getting any depreciation benefit at
yeah.
all.
Yeah.
And so you would just lose $18,000. That'd be a small tax saving, but you're still going to be down, right?
Yeah.
Cash.
Cash.
We don't want to lose cash. No one wants to lose cash. It's not an effective strategy at all. Unless you really think there's going to be a long-term growth in that property, then okay. But, that's not likely in the next few years anyway. So you probably just wait for a few years and then buy it. But each individual, let's have a look at it. But where you buy, say you bought a new property or it's only a few years old, you might be able to write off a part of the cost of the property, the building, as depreciation. And there's people that prepare these depreciation statements that you buy it once and it might cost you $450 to buy it. Essentially, you've got how much you can write off.
Yeah,
a report
schedule. Yeah.
How much you can write off from a capital works and fixed assets component that will become a tax deduction in your return.
Yep.
But there's no cash outlay other than the initial purchase of the report.
Yeah.
So now when you take that into account, we've got a much bigger deduction.
Yep.
Which is $43,000.
Yep.
And therefore, like the tax, your taxable income is reduced. These two individuals are both reducing by $21,000, which is essentially then saving almost like 47% of that each.
Yeah.
which means they're saving 19,000 here.
Yeah.
Which now we're saving $19,000 in tax, which is cash, but we're only spending $18,000 in cash
On the
expenses.
On the expenses, yeah.
And so in this situation, you're actually $1,300 up a year on cash because of that. Even though from an operating point of view, because of the depreciation, that's where the saving is.
Yeah. And we run a lot of these sort of reports for our customers, depending on either or, whether it's an existing dwelling or whether it's a new property that they're looking to purchase, because it's important, like you said, like when a customer is looking at, well, I'm going to make this investment which is going to be negatively geared, and if it doesn't have a high level of depreciation and it is going to be at a lower level there, they need to understand, well, what does the cash flow of that look like? Because like you said, you're going to be losing cash on that investment, and it's not going to be offset by anything else on that level. So
and essentially, if you're buying in areas with high capital growth and all the rest of it, then you can still be making money overall.
Yeah.
But you need to be able to fund that cash wise, right?
Yeah.
And you'll touch on that, I guess, like the lending perspective, what this looks like compared to someone who's losing $18,000 or $15,000, and what the banks are going to say about that.
Looking at the overall, yeah, absolutely. Look, it's like you said, from a cash flow perspective, like that's a massive contributor to the strategic advice and where that goes, and we'll touch on that actually in a moment further down the line. I've just realized that I don't think that our audience has been able to actually see our presentation there, so I'm just going to bring it back up here, and hopefully that everybody can see that. All right, so we were up to property in a trust. Okay.
Yeah.
All right. Look, one of the other things I just want to talk about is the lending implications when borrowing through a trust, and that's just to touch on exactly what we just looked at there, which was the cash flow aspect of the property. So when the banks assess the application in the trust, then they understand that level of negative gearing, and they understand that the depreciation and that the trust typically doesn't have, because when the banks are looking at lending to a trust, it has to typically be a non-trading entity. Okay, so that's one of the key components to lending to a trust. It has to have no business activity, it's just a holding entity. So what happens is you typically will start at a much lower baseline of price point, because again the tax advantages, so to speak, aren't quite there. Now there is I'm gonna have people coming at me going, oh, there is some banks now, like there's always the exception. Okay, there's always the exception to the bank that will give you a little bit more on the negative gearing even within a trust. Okay, but typically if you're looking for a broad range of lender options and you're buying within a trust and you want to maximize that lending, there's maybe one or two that will allow for that to happen. Majority of those, if you come purchasing in a trust, your baseline purchase price is much lower than what it would be if you were buying in individual names, simply because of the tax advantages that ultimately go with being able to offset some of your income. Okay, so from a lending perspective, they're the things that we need to consider. There's also a lot of I guess sort of noise and I guess commentary online with people talking about buying within a trust, because it does allow for more borrowing capacity, because essentially they can discard the lending in that trust if provided it is positively geared, which we know in this lending environment and in these rate environments and all that, it's very difficult to have a positively geared property unless you've got a large deposit into that property. So and a lot of the banks are now actually pulling the plug on that as well. So being able to actually go to a bank with multiple trusts and multiple properties is just starting to dwindle out. The one thing I always say to my customers when they start to talk about that as an opportunity is that you still have to make repayments on those mortgages. So regardless of the infinite borrowing capacity that you can have, if you're someone who's earning $150,000 and the trust lending allows you to borrow $5 million, you still got to pay that back. And if the rental income and everything isn't supporting that, you're going to be underwater very, very quickly with that type of debt. So it's like what you just said. Is it a good thing? It just depends.
Oh,
it depends. So Suitable for some, not suitable for others. Okay. All right. I hope that sort of helped people, because again, it's a question we do get asked quite a lot. Now, Joe, this is probably where myself and yourself do a lot of our work together, which is borrowing as a self-employed applicant, because I know a lot of your customer base are self-employed. You do a lot of work with small to medium-sized businesses, helping them strategically on their businesses as well. And when we work together on it, I call it banks versus accountants in terms of lending policies and practices. So let's talk about what a good accountant helps their customer do. What if someone comes up, what does that look like?
I think like the biggest thing that we find is from a client perspective, and everyone, including myself, because I'm the one doing the tax, is we want to reduce your tax, right? But some people's focus is so purely driven on that they forget that it affects other things in their life, like borrowing capacity.
Yeah.
So I think the main thing is we want to maximize accounting profit.
Okay.
In terms of, you want to show that your business is strong.
Profitable, yeah.
Profitable.
Yeah.
And because from a lending perspective, then you can go and do what you want. And then having tax adjustments to that, for example, putting more money into super, or depreciation, being a tax adjustment but not affecting your cash.
Yeah.
These kind of things, playing with those, timing of dividends to shareholders, and having that trust being able to distribute to different family, like, the group.
Yeah.
All these kind of things to minimize your group's tax without affecting your ability to go get money.
Yeah.
Yeah.
Yeah. Yeah.
And I think that's where, like,
it's the balance, right?
Yeah.
It's the balance of being able to build a level of wealth in terms of acquiring assets. Obviously, your business is an asset as well as, property, and being able to grow that business at the same rate as still being able to, invest in assets and leveraged assets, so to speak.
Correct.
And I think that's a really important part to just touch on, is the balance side of it. And I think that's where we work well, in the sense of, we can do a bit of, I suppose, maybe call it tax planning or planning, so to speak, where someone, and I know you have a conversation with customers, which is, when are you looking to buy, or are you looking to borrow money? Because obviously you understand that this is going to impact them sitting in front of you saying, I don't want to pay that much tax this year, you got to help me out. And versus, okay, well, is the plan to borrow any funds, because we need to, we might get Brian on the phone here, have a chat to him and see what his aspect is, because
it's not an immediate change. It might be 12 months, 24 months of planning to essentially put yourself in a position to get the loan that you want to buy the houses that you want.
That's it.
And if we're lodged 2025, that's lodged. I mean, you can amend, but it's going to be odd.
Yeah.
And a lot of work. So is that then going to affect your borrowing capacity for 2 years? You know, 1 year, we do. Yeah, it's a lot of planning, but it needs to happen. We want to be showing that you're making money.
Yeah, for sure.
Whatever way it is. Whether you're paying tax, we want to reduce the tax, but we want to show that you're making money.
Yeah, that's it.
That's the balance.
Yeah, exactly. And I say to customers, one of the also biggest thing that we would find is there's a confusion of revenue and profit, because ultimately, your customers' businesses better than probably they do themselves, right? And the banks don't. The banks can only work off the bottom line, which is essentially revenue less expenses is the profit. And that's what's left over at the end of the day after everything gets paid out for the business. So,
and they're really going to look at the cash profit. So they add back depreciation and the things that aren't cash items.
Yeah, that's right.
And they'll add back the salary that you pay yourselves if you're part of the group, essentially, to the owner.
Yeah.
And they'll look at what your whole group's income is, profit on that business, but that's essentially what they'll look at. Yeah,
so the I suppose it's a good segue into the next point I have here, which is how the banks assess self-employed applicants, which has changed quite dramatically over the last sort of 24 months, I suppose. Well, definitely 12, maybe 24. Time sort of flies in this industry. So where previously, we would ask our customers, well, how much are you paying yourself a salary? And the response would be, well, I can probably pay myself anything. And that didn't fly either, because the bank guy who's signing off on the loan application knew that that could be the case. So what they've changed in terms of adapted as a policy is to actually look at businesses that have the ability to pay, or you as a director to draw that salary out of the business on an ongoing basis. Now, what I mean by an ongoing basis is typically over that sort of 6-month period, and be able to show consistency of that. So it's a case of not where we look at, what did the individual tax returns say 2024, 2025. They've got the capacity and have been ongoing paying themselves for the last 6-7 months now, and they have the ability to show that consistently. The bank will now start to adapt that into their policy to be able to say, yep, okay, this person is earning 80,000 a year, or whatever that so happens to be. Whereas in the past, it was, what was the net profit of the business? What was the tax return that they paid themselves? That plus any add backs. And then they had a good year in 2024, but they wrote off, or 2025 was for whatever reason. So you had to juggle between the lender policies, which was who was going to take the average. If the one was down, who would go back and look at the last one and then take it a bit of a more holistic view of it. And I always found there was a bit of frustration with customers, and rightly so, because they feel I can pay this loan, and that's the rhetoric or the response is, I can pay this loan, like I have no problem with that. Because the problem was just, I got to see the paperwork
that supports that.
Supports that. So it's just a really, I suppose, important thing for anyone who's here who's self-employed and looking at sort of borrowing money, having a good accountant and a good broker that can talk to each other and understand those policies to help guide you in that sort of journey forward. Okay. One of the other points I've just put in here is the alternative lending options for self-employed applicants. Customers who, let's say, maybe haven't got their tax returns up to date, but have got really strong BAS, they can, they're actually generating good revenue, they're paying, all their BASs are getting lodged on time, and all of that is there. But for whatever reason, the financial year has got away from them, or the new one hasn't ticked over just in time for them to get that finance. There is the alternative out there for lenders that will consider, what have you got on the BAS? What does the bank statements look like? And a few things there is just, look, interest rates generally, it's a little bit more of a risky loan to the bank, because they're probably taking a little bit less of a, deep dive into the financials. But you've helped us with that in the past as well, so get BAS
more of a
statements.
low doc.
Alt doc is sort of where we look at, but essentially that's where we go. So customers who are self-employed, we have those options for you out there as well. And again, we'll liaise with accountants to essentially get that through for us. Okay. This is just maybe one that I've sort of brought to the fore, because again, we've done quite a bit of this and with you guys in the past in terms of borrowing money within your business, or borrowing money for business purposes. How does that affect your borrowing capacity when you go to buy an actual investment or a property? And I suppose maybe some of the questions that customers might be looking at is when is it worth it for a business to borrow money? So if I'm a customer of yours, Joe, I come to you and say, look, I'm thinking of borrowing some money to do X, Y, and Z or something there. Like, is there any sort of particular metrics that you guys would have a look at for a customer, or what does that typically look like?
Yeah, I think you got to look at what are you using the money for? Will that increase the business profit, for example? Are you gonna, so for example, if I went to borrow money, I'd hopefully use that to buy another accounting firm to tack on. So therefore I'm going to increase my profit, and I can use that profit to pay down the loan and that kind of thing.
Makes sense.
When you can get yourself in trouble, I guess, going the other way is if you're borrowing money, you're losing money in the business, and then you have to go borrow money to then try and keep the business alive, when you probably should have liquidated. So that's where you can get yourself in trouble personally, if you've guaranteed it, and that kind of thing. So I think when you have a strong balance sheet, so your assets and liabilities, net assets of the business are high, you're generating good profits, and you want to use money to go and to expand, then it's worth it. I think when you're losing money and you're just trying to hang on, I think you got to really assess that.
Yeah.
Because are you going to be able to actually meet those repayments?
Yeah.
Within the business itself, let alone, I wouldn't even talk about borrowing money to buy property at that point.
Yeah.
Yeah.
You guys do a deep dive on that, or would it be I suppose, like, is there any, I guess, formula to it, or is there any, I suppose,
Yeah.
call it the strategic advice component that comes into play?
Like you would want to look at a cash flow of what that looks like.
Yeah.
I mean, it really depends on the business, and I'm going to say depends again, but you know, if people just need a loan for working capital to plug into the business to grow to the next level, and they know that by getting this loan they're going to then get more customers, and they've got a history of that.
Yeah.
And they can support the growth, then they're going to be looking all right, and it's a small loan anyway, so it's not as big a deal.
Yeah.
But I guess like when you're just getting the loan to hang on, and you're not actually going to use that to grow the business, like you're going to struggle.
A bit of a non-runner, really, isn't it? Yeah. Some tough conversations that would need to be had, I suppose. But at the end of the day, best interests of the person, really. You don't want them to be chasing the...
I wouldn't be securing against any personal assets.
Yeah. Good shout. Look, just business lending affecting borrowing to buy a residential property. So again, this is one that comes up with us quite a bit. Again, bank policy is going to dictate a lot of that. If we have to delve into the profit of the business to support the actual lending, generally speaking, the banks will typically look at including those liabilities. It's a funny one because typically speaking, that the profit is generally after all the expenses to all the loans are completed, and that's the profit. And as soon as you start using that profit for the borrowing capacity, they start adding back in the expenses in the business lending, which a lot of the time can deplete the borrowing capacity, because it's almost a double dip to a degree, because the expenses are already taken out of it before.
Well, only the interest is taken out. So if you look at your profit after, your profit includes the interest component, but it doesn't include your principal loan repayment. So the bank's going to go, okay, they make $1 million after interest and tax.
Yeah.
But they need $500,000 to repay these loans every year. Then they're going to say you have $500,000 to deal with, like to be able to borrow more money, right?
Yeah.
So like they're going to take that into account. If you're using a different metric, then they might not look at it, as you said. So if they're looking at personal wealth, how much am I getting in the bank every month? That's my borrowing, like based on that's my borrowing, then they're not going to really look at that so much.
So that's the scenario, is that newer policy, which is I'm paying myself a salary on a consistent basis,
or a dividend,
and I can support it, then, well, it'll be more so a salary.
Okay.
So they don't necessarily, the dividend is looked at in a different light, because a dividend is essentially on the performance of the business, okay, rather than I'm treating myself as an employee and I'm going to pay myself as if I'm an employee, versus again the dividend is tangible to the performance of the actual business profitability. So it's just something again to be mindful of, in the sense of, if you're looking to borrow funds in due course and there's business lending involved, we're going to be not restricted but limited, I would say, in terms of lenders that we can typically look at in that situation. So again, just good planning generally sort of gets around it all. So it's what we want to look at.
You can touch on this first one, mate.
Yeah, look, I guess property strategy, and exactly what does that mean when we do say property strategy, and we talk to a lot of your customers about this as well. But property strategy, we find, and this is where I guess our business has seen a little bit of a niche in terms of what's on offer, is that when a customer wants to buy an investment property, they generally are going to talk to a number of different professionals and services. And the first company they might speak to is, let's say, a property group, buyer's agent, or somebody who specializes in sourcing and buying property for a customer. Then they'll speak to finance, because ultimately they want to make sure that they can borrow it. And what happens often is that you have a misalignment to a certain degree, where someone who's looking to help you buy property, the first question they're going to ask is generally, well, what does your borrowing capacity look like? And then what happens then is the customer will go, I'll find out, well, what does my maximum borrowing capacity look like? And then the finance team will say, well, what are you looking to buy? Or what's your price point that you're actually looking to purchase at? So there's this sort of level of not cart before the horse, but it's like, all right, well, we can max you up to this depending on we get this amount of rental for the property. If we don't get that rental, or is it going to be a new, or is it going to be an established? So there's a lot of factors that fall into the mix when it comes to making a decision around what type of property that customers are looking to buy. And when we then look at again, our strategic offering is that, well, what is the biggest driver of decision making in investing? And generally speaking, we found is that affordability. So regardless of what the banks say you can borrow, and regardless of how much this property is valued at, or whatever that looks at, if I am going to be looking at the last dollar in my bank account every month to pay that mortgage, if he's late on rent, I'm going to be in trouble. Okay. The second thing then we look at is, what are your aspirations? Because if you've got aspirations to build a property portfolio of 3 to 4 investment properties, and your income is, I'm just going to say, a person who is I'm going to use a government role as an example, because typically it's a salary that has tied CPI inflation year on year, that gets that incremental increase.
Teacher.
Okay? Teacher, for example. Okay. And applicant number 2 is, again, let's say somebody who's in, I'm going to just say, an administrative role that has a base salary as well, with no commission, overtime, or bonus incentivized. Okay. Now, that person is going to have a borrowing capacity. Now, do you look at a maximum borrowing capacity, which basically tells me that something dramatic is going to have to change in your life in terms of your employment in the next 2 to 5 years, or you're going to have capped out at, let's say, a 650, 700K price point, and that's it, okay? Or do you look at, well, if you want to do 2 investment properties, we need to bring the price point back and actually look at, well, how can we achieve the 2 investment properties rather than going for that one that is at your top end? Versus, let's say, I'm going to use somebody who works in a commission-based industry, which is someone who works in real estate typically, right? A real estate agent. Sales. Yeah. Someone who's got a tangible commission structure to their performance. And year 1 they could be making 200,000, and in year 3 they could be making 400,000. Okay, they have the ability to be able to really be ambitious because they have that variable component to their borrowing capacity, and you can again tangibly link that property portfolio to, you're going to have to make X amount of commissions that year in order to be able to get to that step. Is that achievable in your role? Yes, it is, or no, it isn't. Okay, all right. So that is point 1 of developing a property strategy. What does the income structure look like, and how does that get performance, or how does that typically look like in terms of borrowing capacity? And then you go into your living expenses, because just because I'm earning 800,000 or $1 million a year doesn't mean I've got surplus cash, because I can tell you one thing, in my years of sitting in this seat, the more people
earn $1 million a year earnings, the
more money people earn, the more people spend. Okay, so again, that's a very tangible.
Private schools come in,
all of that.
All the rest of it,
the nicer cars, the more debt, the this, that, and the other. All the bigger principal place of residence. So someone who's earning that huge amount of income, generally the outflow is a lot higher as well. So delving into the cash flow of the household. Okay, where are you spending your money? This property that you think is going to cost you this amount of money is actually going to cost you this, and we need to now see, well, this property is going to cost you $200 a week. Can you afford that? Okay, if rates go up, what does that look like for you? So by delving into those, cash flow is going to be able to help us deliver a better strategic offering for that customer, rather than just going, your max borrow is this, or your borrowing capacity is this, back to the buyer's agent or your property consultant and go, that's where that looks like. Okay, rather than actually going, right, well, what is it that you want to achieve? Because great, we can get you 1, 2 investment properties, but is that going to get you to the point where you need to be X, Y, and Z? And your income structure is probably not going to get you there. You know?
Yeah.
So that then can dictate, yeah, we go for the more expensive property because we go for one that has a higher rental income or a better property or capital growth.
Yeah. The number of properties is always like, to me, it's not the number of properties you own, it's more the value of them and the growth of them.
Correct.
And the yield of them.
Correct.
So yeah, you got to mix all those things together. I mean, you've also got more administration when there's more than one property, all the rest of it as well. So like, you know, you got to have a look at it across the board.
Yeah. And look, this comes to my next sort of point on the slide is why is it important to have a solid plan when you're considering investing in property? And the one thing I always say to customers in this instance is that it takes away the emotional aspect of it because you should never be looking at this that you're going to live in it. Now, granted, there's always the exception to the rule. You know, I might buy this with a view that in 5 years' time I'm going to retire. That's sort of something somebody might be in their sort of late age of working career, etc., might go for. But generally speaking, you're looking at this as a numbers driven activity that's going to give me the yield, give me the capital growth. And when you develop the plan, it just gives you that foundation of, well, hold on a second, am I deviating from what I originally set out on this? And it again takes the emotion out of it because you can often walk into a property that's next door that you think, well, I'm looking for 750, this one's 900, it's giving me a 3.5 yield, but I really like the house. It's like, well, it's completely off center of what we've actually developed for you. It's going to impact your cash flow. You're going to have no cash reserve. You're buying it because it's around the corner of the house from your place that you think you're going to be walking in every other day checking on it. I promise you're not.
And it's going to affect your day-to-day living.
And it's going to affect your day-to-day living, all of that.
Yeah.
So having the plan just basically means that you stop going this way, this way, this way. You've got a clear pathway in terms of what that's going to actually look like. So
the capital growth component as well, it's really important that you're buying in the right areas at the right times.
100%.
Otherwise, you know, if you buy at the top of the market, well, like you're going to have to hold it for a very long time to actually for it to
see
grow.
the return on that. Yeah. And like I said, if it's costing you 10 or 20 grand a year and every year that ticks by in 5 years time, it's cost you 100 grand.
Yeah. And it's gone up zero in value.
So
may as well buy it in 5 years, right?
That's it. So they're the things that the planning will ultimately get you rather than the sort of scattergun approach to it. I think it would be, I suppose, something like of a oversight if we didn't talk about the future of property investing, and is it still going to be a viable investment for everyday Australians, just in general with the cost of living, cost of property. Everything seems to be exploding in prices, and that's not just from property, that's your bloody weekly grocery shop.
Absolutely.
Like, what do you think, Joe? Is it a
I mean, I think we're sort of starting to get into the market where you really got to pick where you're buying, but also like, is it worth buying at the moment?
Yeah.
Like, it will be definitely viable to buy property, and we're not saying don't buy property, but you don't want to just buy a random property for the sake of it.
Yeah.
It really has to be the right spot, the right time, the right money, the right yield, all that kind of stuff. Do the research. And I think like with Labor in charge at the moment, they're looking at the tax part of property to help alleviate the housing shortage. Will capital gains discounts, which is if you own it individually or through a trust, you get a 50% discount if you own it for more than 12 months and you sell. Like, that's been looked at. There's nothing in whether that's actually going to come. I think there'll be a big backlash if it does, but and these kind of measures, negative gearing, can you utilize all your properties negatively geared against your income, all these kind of things, they're certainly on the table to be looked at. So I think you got to be a little bit cautious with that. What are your thoughts?
Look, it's a topic that gets brought to me quite a bit as well. And I suppose one of the things I would just say is that, you know, property is a very not say controversial topic, but there's a lot of people that have invested into property, and any changes in the legislation around property is going to affect a lot of people, and
including the politicians themselves.
Including the politicians themselves. So, you know, is it headline sort of stuff? I think sometimes it kind of is in the market for, you know, to appease certain people, to kind of maybe look like, well, we are kind of considering things, we're putting it on the table. You know, there's always tax aspects that are up for discussion, and, you know, it'd be, I guess, naive of us not to think that at some stage some level of property tax is not going to be reviewed. But ultimately I feel like that it'll be investigated and it'll be basically put to the side.
It'll take a long time to bring in anyway.
Yeah, that's it. And one of the other sort of things I'll kind of think about is that if they do bring it in, what does that look like? And for most property investors, my sort of take on it would be is that they would just probably not sell the property. Like, they would essentially hold on to it to the point where they, you know, instead of, let's say, buying it for 10 years and then maybe on selling it after that, which gives another buyer an opportunity to get into the market, they don't sell the property, they hold it forever until they get to the end of their life, and maybe just live off the income, pass it on to their kids, or sell it in 30 years time, which could ultimately have a backlash in terms of supply effect, because if investors aren't selling property, then ultimately that's going to reduce the amount of transactions that are going to be on the market as well. So
we could be here all night talking about this. So
we could.
Like, honestly, there's so, like, do they bring in land tax for every property? All these kind of things. Like,
yeah,
you know, I think, let's worry about what it is at the moment. But no, you have to consider it. But there's so many things could change.
Yeah. Look, for sure. Look, last sort of slide that I have for this afternoon are pitfalls in accounting and property investment. Look, I think we sort of touched on this one already, you know, particularly for business owners, what the pitfalls that people often fall into when setting up a business. And this is also, like you mentioned, the ongoing sort of like tax minimization, looking to build wealth. I think I said, you know, I always feel like that income and is there for servicing debt. It's never going to get you to pay it off ultimately. Building
unless you sold a business, or, you know, that
selling assets is ultimately where you're gonna sort of reap the rewards of building that wealth for yourself, you know?
Yeah, I mean, for us, the biggest pitfall is one, like, really the structure and which entity they set up a business in, or they buy property in, and all that kind of stuff. And once it's done,
it's very
as you know, like, if you transfer a property to a different entity in your group, you still pay stamp duty again.
Yeah.
So you want to get it right at the start. And there are tax minimization things where you do it because it's saving you a lot more tax.
Yeah.
But that's not an ideal situation when you have to pay stamp duty again at market value.
Yeah.
Which I have had to do, but that's okay. That was strategic.
Strategic.
That was deliberate and not the miss
the mark. No, fair call. Well, look, just where do people go wrong with investment property? And that just comes back to you, and we've touched on it sort of this afternoon as well, is, look, ignoring, you know, there's aspects of investing in property that people go for the yield of a property. So that's obviously the high rental income from a property, or people make a play for the capital growth, looking to find an area that's going to the next boom area. And that's something that a lot of people are sort of obviously looking for. And, you know, where people go wrong with is they miss the mark on both of those, you know, like, so again, that just comes back to not having that sort of strategic plan. It might be the emotional buy, the house around the corner, you know, overpaying for it, not getting the yield. That area has already seen the uplift in the last 5 years. So like you said, they're waiting another 5 years to get the capital growth there, and they're just burning money to wait for that. So strategic planning, I have to say, is probably
No, it is, because it comes back to the yield and the capital growth that you said, and the tax benefits, and the whole structure. And do you want to pass it down to your family later on? All these kind of things. You really need to think about these things. Or are you buying, renovating and selling? Okay, that's a short-term play, less than 12 months. That has a whole different structure compared to it. So really get that set up first, plan for it, what's it look like, and what's it going to look like over 20 years.
Yeah.
And then make it happen.
Yeah.
I might touch on quickly, if you don't mind.
Sure.
self-managed super funds.
Oh, that's right. Yeah.
Yeah.
Please do. Yeah.
So essentially, I get a lot of questions, and I know you get a lot of questions on buying property through an SMSF, self-managed super funds.
Yeah.
Essentially, the self-managed super fund itself will have a borrowing capacity, which you can touch on if you want.
Yeah.
But it will look at what the earnings and the contributions that are going into the fund, plus the rental income.
Yeah.
And if you have debt to buy it, you can do that in the fund, but you have to set up a bare trust as well.
Yeah.
So there's an additional amount of admin to set up the self-managed super fund if you don't already have one. So it probably costs you, $4,500 just to set it up because you've got this bare trust structure as well. Obviously, if you buy a property in a self-managed super fund with no debt, you don't need that bare trust.
Yeah.
But it segregates your other assets.
Limited recourse.
Yeah. So I don't know if we have questions on self-managed super funds, we can take those as well. But it is something to think about because sometimes you might have hit your borrowing capacity individually, but you've got this massive deposit
sitting
there. Do you want to look? I mean, there's liquidity issues that if you hit retirement age and you're trying to pay a pension and you're not getting the yield.
Yeah.
So there are things to consider there. You wouldn't want to just have a small
deposit.
House.
Yeah.
A small deposit and small property in that fund.
Yeah.
If you might have to sell it to just pay a pension kind of thing. Yeah. So it's what does that look like? You need the advice for that as well.
Yeah. It's I had it actually. I did miss it, so apologies on that one as one of our topics. Because it's something we do quite a lot of, obviously in our space, and the self-managed super fund, like you said, is a great alternative for the investor market who are, like you say, capped out on that borrowing entity in their individual names and looking towards that as the alternative. Capital gains exemptions are pretty strong there once sold in retirement. So there's quite a fair few tax advantages in that space.
I mean, even if you sell it and you haven't hit retirement and turn it into pension, you're still only paying, if you held it for more than 12 months, only 10%.
10%. Okay.
Which is nuts, right?
Yeah.
So even if you haven't held it for 12 months, only 15. So
still.
Yeah. I mean, ridiculously low compared to individual. That's where you get the best tax benefits.
Yeah.
The other one is, do you own the commercial property that your business is renting it off from market value and having that structure there. So there's a lot of benefits to it. It's not for everyone though.
Yeah.
So we need to see what that looks like.
Yeah. And again, one of the things we've worked on is we speak to the customers, we can do high level because obviously there's an expense that goes with the setup of the structure. So we can give customers, this is high level, this is what you'd be looking at in terms of overall borrowing capacity and purchase price, etc. And then be able to then go, right, let's get the trust deeds all set up because that's ultimately the borrowing entity. And then we're back in to get the application formally into the lenders to do it. So
and then we'll help with rolling your other balances into the super fund, making sure a bank account set up, all the rest of it.
Yeah.
So
Perfect. Okay, so I guess I'll open it up. So we've sort of hit time on the session. If there's anybody at all that has any sort of questions at all that they'd like to pop into the chat, please do.